Alright, how's everybody doing? I'm Professor Manfeld Jr. and today we're talking about inventories, additional issues. So to start, GAAP requires that companies report their inventory at lower of cost and at the net realizable value. So what that means is companies avoid reporting inventory at greater the amount than benefits they can provide. And this relates to the GAAP's overall principle of conservatism in accounting, because you don't want to say that you have more inventory than what you actually have, because it'll throw your numbers off in the end. And losses reported in the period where value of inventory declined below its cost rather than in the period where goods are sold. So that means the inventory is reported in the period before goods are actually sold in the market. And this has critics because your numbers could say that you didn't make as much money as what you really made, or your costs were too high compared to what your real costs were. But it's the GAAP principle, so it's what we have to follow. In the next period, we're going to learn about what net realizable value is. Professor Manfeld Jr. here, back again with another lesson in accounting. Alright, so today we're going to find net realizable value and inventory value. So let's start with the formula for NRV. So NRV is equal to selling price of a good minus estimated cost to sell. Estimated cost to sell has to do with sales commissions and shipping costs that come with selling a product. So we've got a little example here. So let's say we have product A and product B. Product A cost is 50, the selling price of item A is 100, and the estimated cost to sell is 15. For item B, cost is 100, selling price 120, and estimated cost to sell is $30. So to find the NRV, we take the selling price subtracted by estimated cost to sell. So for item A, cost is 50, NRV would be 100 minus 15 to get 85. And for item B, the NRV would be 120 minus 30, which gets you 90. So how do you find the inventory value? Well, to find the inventory value, you have to figure out the lowest number of the cost or the NRV. So for example, for item A, the lower number is the cost, so inventory value is 50. And for item B, the lower number is the NRV, which is 90. So therefore for item A, the inventory value is 50. The NRV is 90, and this has to do with what we talked about before, having to do with the lower cost of the inventory it's reported.
Hello, my name is Sean Heisler. I'm going to be teaching you guys how to calculate lower of cost and NRV. First, you need to know that lower of cost and NRV can be applied to either inventory items, categories, or the whole. So let's look step by step on how to do it. So you'll have your cost and your NRV for each items. Now in order to find the lower of the two for items, you'll take the lower number of each individual item and then add them up, as you can see here, and then that is your total for the lower cost and NRV. For product lines, you take the lower total of your items, this being 150 and this one being 256, and add those up, and that'll give you your total for that. Now, to find the lower cost in NRV for your total inventory, you just look and see which is the lower of the two numbers for your totals, and then that is your final answer. Okay, so when the lower cost in NRV of either the inventory product category or the whole is lower than the regular total cost, then a write-off is needed. So for example, if total cost is equal 500,000 and the lower cost and NRV for individual products total equals 471,000, then a loss is recorded. This loss would be 29,000. And then you would need to write that into your journal entry and use a disclosure note. There are two ways to record the journal entry. You can either do cost of goods sold debited and inventory credited, or you can do loss on write down of inventory debited and regular inventory credit. Thank you.
Alright, I'm going to tell you how to estimate ending inventory and cost of goods sold using the gross profit method. And this is useful when you need to determine the cost of inventory that's been lost or stolen or destroyed. It avoids a physical count, and auditors can test the reasonableness of the amounts reported, and it's useful for budgeting and forecasting. This is just an approximation, and it's not acceptable by GAAP on any financial reports. So the first thing you need to do to find this is you need to estimate the cost of goods sold. And to do that, we use the gross profit ratio, which is gross profit divided by net sales. And once you find that, you can find the ending inventory. And you're going to start with beginning inventory. You're going to add your net purchases, and that'll give you your goods available for sale. And then you'll subtract your cost of goods sold estimated that you found using the gross profit ratio, and that'll give you your ending inventory.
The last in, first out method assumes that units sold are those most recently acquired. An increase in inventory quantity during a period equals ending inventory that includes beginning inventory as well as an additional layers during the period. A net decrease in inventory quantity equals LIFO layer are liquidated.
Hi, my name is Dr. Freedom. I'm going to be telling you a little bit about the retail inventory method. Now, it is similar to the gross profit method because it relies on cost and selling price to estimate the ending inventory and the cost of goods sold. Now, this is very popular with the high volume retailers such as Target, Walmart, Sears, JCPenney, and Macy's because they have a wide variety. Now, the principal benefit of the retail inventory method is that a physical count of inventory is not required to estimate ending inventory and cost of goods sold. Now, all businesses need to take care of their retail information, which records the records of inventory and purchases, not only at the cost, but at the selling price.
Learn to you about the cost retail percentage here. Cost retail percentage is used in retail inventory method. This percentage can be used on financial statements. It is computed by taking the goods available for sale cost divided by the goods available for sale retail. So here we got an example here. Well, first thing you want to do is find the goods available for sale. So you got your cost category and your retail category right there. So what you do is take your beginning inventory price plus the net purchase price, and that's the goods available for sale. And so we already did that here. We got 347 and for cost and 560,000 for retail there. So cost of retail percentage, you take the cost, which is 347,200 divided by 560,000, and you get 62%. So that there's your cost of retail percentage. I want to let you hear some retail terms. You got initial markup. What that thing is your original amount of markup from cost to selling price. Additional markup is increase in selling price subsequent to initial markup. Markup cancellation is the elimination of additional markup. Markdown is reduction in selling price below the original selling price. Markdown cancellation, elimination of markdown. Right, so basically we have here, as you can see, the original cost is $6. Okay, so you want to sell that for a $4 markup, which will give you original selling price for $10. Well, you say, hell, I can get $2 more out of that. So you raise the selling price to $12. So that's $2 more dollars that is additionally marked up. You say, hey, it's not selling like that. I'm going to take $1.50 away. That's your markup cancellation. Your selling price is now reduced to $10.50. And that there is example of a markup. Okay, here you got the same thing. You got your original cost of $6. You say, hell, I'm going to sell that for $10. That's a $4 initial markup. You say, hey, I'm not going to get $10 for it, so you know what? I'm going to mark it down for $3. Now your selling price is reduced to $7. So you say, hey, you know what? I'm not going to make enough money. You then make it $8, so you have a $1 markdown cancellation. And that there is an example of markdowns.